Head of trading at the place where he works. Financial coach and author, Raphael Dazet is one of the few traders I've interviewed on A Trader's Life who does not trade on leverage. He's just written a book, Million Pour Tous, which roughly translated means anyone can make a million. A little glib for some, no doubt, but you can be sure Raphael will go to some lengths to show you how it can be done. Here we are in Raphael's apartment in Paddington, London, 2023. Raphael, hi, welcome to A Trader's Life. How are you doing?
I'm all right, thanks. And you?
Good. Yes, very good. And we're in Paddington, your place, today.
Yes, we are.
Very good. And how long have you been in Paddington?
I've been here for 13 years now.
Yeah.
Since 2010. And I love this area. Great, very central. Love it.
Yeah, and originally you're from?
France. From France. I moved from Paris in 2006. So I've been in London for 17 years now.
Yeah, and what brought you to London?
Different things. First, I wanted to improve my English. At the time, wasn't great. I wanted to work in financial markets. Wanted to make more money. Wanted to live abroad. The experience. And in 2006, I had the opportunity. So I was working in Paris at the time. I had the opportunity to do a training in English with my former company. I spent a week there. I stayed at my sister lived in London at the time. I spent the whole week. It was during the World Cup, the 2006 World Cup. It was great. I was following my training in the morning, at the pub in the afternoon, watching football. Yeah. That was paradise to me. And I think I resigned 2 weeks after I came back to Paris. That week was so good. I decided, okay, now is the time. I need to move to London.
And so, early life, have you kind of got a tradition in your family of financial expertise? No. Why the financial markets and why trading in particular? Because you're now head of trading where you work, so you've clearly not moved from that, except upwards. But head of trading, that's very impressive. But why trading in particular?
I've always loved figures. Since I was born, so during my studies, I knew I wanted to work either as an accountant or in financial markets, in finance in general. And I started in Paris. I was helping traders. I told them when to buy, when to sell, mainly on futures. So I was doing technical analysis. And that's what really gave me the passion of trading. But that was not the core business of the company I worked for at the time. So I was doing a bit of that, but then in the end I became the CFO of the company, so more corporate finance and financial markets. And that's when I decided. I did 2 years of corporate finance, CFO, and that's when I decided to go back to financial markets. Moved to London, and here, so I resigned from my job in Paris. I moved to London. I didn't have a job when I arrived here, and got lucky to find a job as a trader.
Are you more an analyst or a trader at your current position?
Trader.
Okay, yeah. So you are regularly taking trades.
Yeah.
Every day you're opening trades for clients and so on.
Yes.
Yeah. And what do you trade mostly?
Mostly equities and FX.
Yeah. Do you have certain pairs that you favor? I guess the most liquid ones?
The main ones, the G10, so euro, dollar, pound, Swiss francs, all the European ones, plus the 10 biggest ones. So plus dollar, Canadian dollar, Australian dollar. Nothing, it really depends on what the portfolio managers want to do. And the area I'm responsible for, the PMs only invest in the main markets.
Okay, so what's the typical structure of your day? You go into work in the office, you have your coffee, sit down with PMs, portfolio managers, to discuss the plan for that day, and then maybe around about 10, 11 in the morning, your British time, you're taking trades that you've agreed on? The
markets open from 8 in the morning to 4:35. That is the equity market. FX, it's non-stop.
Yeah.
So we try to be in the office an hour, half an hour before the open. we discuss with PMs, as you say. We trade. We don't take the decision what we want to buy ourselves. I don't take this decision myself. The PMs make these calls. But what they ask us is, I want to buy, let's say, 1,000 Apple. I have to give them the best price. They would tell me, I want to trade as quickly as possible. I want to trade at the close. I want to trade over the day, over the next few days. They give us some sort of guidelines depending on the urgency of the trade. And with that in mind, we have to get them the best price possible and complete as much as possible. So when we have small size, it's easy. The trades only last a few minutes or seconds sometimes. But sometimes the sizes are huge, and we need days, weeks to complete the trade.
Yeah, to be able to enter, because you can't just dump a whole lot of money on the market,
exactly.
can you?
Otherwise, we move the price too much. Yeah. So we have to be careful, and we are judged on the what we call the market impact. So the difference between the price at the time the PM gave us the instruction and the price we end up with, the price we execute at. Yeah. We try to minimize this difference. So, for instance, if the PM wants to buy at 100, if we manage to buy at 99, we are good. If we manage to buy at 102, we are bad. So overall, that's how we measure our performance.
Cool. And can you describe a typical scenario where you don't quite agree with the PMs and perhaps you push back and you advise something different?
It's when they say, for instance, when they say, I want to trade as quickly as possible, but if there is a big news, for instance, Bank of England or something, 30 minutes later, we might advise them to say, now might not be the best time to trade it. Maybe let's wait a bit more. Or the opposite, if they want to trade at the close, they say, be careful. There'll be lots of volatility with this Bank of England decision. Maybe we should do it. We should do it now. Stuff like that. But so it's more on the timing of the trade rather than the decision to invest in the stock.
Because normally you find their analysis aligns with your analysis. Is that right?
We don't do the analysis at all. So they do that. They have the PMs I'm working with. Well, most of them at the moment, they use a quantitative model. So the model will suggest some recommendations. Then they look after the recommendation from the model, they approve or not. And then the order comes to us. On our end, our added value is more on the timing and be able to complete the trade as quickly as possible.
Yeah.
But we won't change also, if something happens in the market, for instance, if there is a news on that stock or something, we would tell them and they might change their mind. But in the end, the decision to invest, to buy or to sell, is strictly on the portfolio managers.
What do you do when a decision that you've arrived at as a group turns out to be wrong? Are you sort of sitting down and going through an analysis, a sort of post-mortem of what went wrong? I mean, there are so many times I've been listening to very good traders, very experienced macroeconomic people, silver's going up, and then almost the same day, it's just tanks right down.
Yeah.
And so you think, these guys have been in it, for instance, a lot longer than I have. I've been doing this just 2 or 3 years, But I then become very wary of taking their advice. I mean, there must be, therefore, for you ever so often, instances where you have collectively agreed on a move and it's gone disastrously wrong.
It's gone wrong, yeah.
What do you do in those circumstances apart from throw things in the office?
It's not. I mean, being wrong is part of the.
Yeah,
it's part of the job.
Yeah.
It's if we make 100 bets, the goal is not to be 100% of the time right. it's going to be maybe to be 60% of the time right, and that's enough to make. As long as you make many bets, many small bets, that's enough. So being wrong is not necessarily the problem. Being wrong too often is more of an issue. And there are months where our performance is better. Sometimes it's not as good as we hoped, but over time it should be positive.
If you have heavy losses, are you hedging those heavy losses, or are you cutting the losses? I mean, is it a bit of both? How do you deal with your risk management? On
my side, on the trading side, I won't have losses per se. It's more that my impact will be too high. In the example I gave you, if the price starts at 100, PMs wants to buy, and suddenly the price in the market goes up significantly. First, I will come back to PM. Let's say it goes up to 110. I will tell them, oh, there's been a news in the market, now it's 110, do you still want to buy? It's a discussion between them. Maybe they still want to buy, but less aggressively. Sometimes they want to stop and say, let's wait. Sometimes we push the price. We try not to, but in that case, if we are pushing the price up because our size is too big, we will try to slow down our trade. So maybe stop, hope that the price will go down to 105, and then buy again. So it's always a discussion with PMs. But the idea is to make many small bets to avoid big losses. When we are wrong on a small portion of the trade, and to always have this discussion with PMs.
So it sounds like you're managing trade size rather than actually cutting losses. I mean, the retail trader is told you must have a stop loss. Are you working with a stop loss? Or?
Stop loss for my own trades, personally, yes, I would definitely use stop losses. In my job, it's a bit different. We don't really need because the PMs wants to buy or sell the stock, so we have to execute what they want us to do. So it's a bit different what I do in my job versus what I'm doing personally. On personal trades, definitely. I would, so if the price is 100, I target 120, say, I would put a stop at 90. The ratio, the potential win, in this case 20, should be at least twice the potential loss, 10. So in that case, that's a good trade. I can do it. If for my potential win of 20, I have also a potential loss of 20, then the trade...
like a one-to-one R.
Yeah, exactly. Yeah. And then the trade is too risky, and it's probably not a good thing to do it.
Okay. Are you very strict in your own personal trading with how you set up a trade in terms of stop loss, you know, what we talk about, the ratio?
Yeah, definitely. Yeah. And in my mind, this ratio should be around 2. Sometimes 3, the higher the better. But yeah, below 2, it becomes risky. Unless you are, if you are 80% of the time right, then you can accept a ratio of 1. If you're only 50% of the time right, a ratio of 2 is necessary.
Yeah, exactly. Yeah. So let's talk about your own trading and how you've developed that over the years. You started with what? Equities?
Yes.
Yeah. And then you moved on to try Forex. Let's talk about Forex for a minute. What was your approach and how did you learn and develop?
Well, Forex, it's not my own trade. It's what I do for my...
oh, okay. You don't use Forex on your own? Okay.
On my own, only equities. I've done a bit of futures in the past, but I stopped that. And now it's mainly ETFs. On my personal trading, I'm more an investor than a trader. I try to, my goal is to buy and to never sell. So I buy every month the same ETFs, equities, bonds, and then hopefully over time the price will increase, which in theory the stocks, the equity market, the annual return average in the last 120 years, it's 6% net of inflation. So that's what you can count on if you invest in equities in an ETF, equity ETF.
Is that with leverage you're using, or?
No,
not at all.
No leverage.
So that massively improves your odds, doesn't it? And you know,
leverage.
Well, no, I mean, no. In terms of making a profit, a steady profit, I think, you know, once you get into leverage, it gets riskier and riskier.
Yeah. I only use leverage for real estate when I buy flats. It feels, I mean, the real estate is far less volatile than the equity markets. So I'm okay to leverage myself on real estate, but I wouldn't do it for equities.
Yeah,
too risky.
Yeah. Have you ever traded options, for example?
Not recently, no. I've tried that in the past, same thing, but it requires some very different skills.
Yeah.
Lots of information. You have to spend the time and you have to have the knowledge, which I didn't have. I still don't have it right now. No, it's a different skill set.
Yeah, it's very popular in the States. I mean, from the little I know about it, really, once you get into it, the safest way, at least, to trade options is these different kinds of credit spreads and so on. You know, you have to combine puts and calls to be able to minimize your risk. Otherwise, you go for a naked call, and if it goes wrong and you run out of time, you lose your shirt.
And there are some very smart strategies you can do with options. If you buy and sell call or puts, you can do plenty of smart things. In my mind, you have to be a professional for that. I'm not sure a retail person can. I'm sure there are some exceptions. Some individuals, I'm sure, make money with options, but you have to have the skill set, the time, resources. I wouldn't say it's for anyone in the street.
No, sure. And why do you only stick with equities? Is it mainly because, well, you have your regular job anyway, and this is the kind of thing on the side, and it just feels so much more secure by comparison to, say, trading Forex on leverage, like 1 to 20 or 1 to 30?
There are only 3 asset classes that can give you a return both with dividends and with the price increase, and it's equities, bonds, and real estate. Anything else, you can only make money with the price going up. So everything else it's pure speculation. So Forex, options, even commodities, all this is pure speculation. It might be good to have some in your portfolio in some cases, but I think most people should stick to equities, bonds, and real estate. On equities, you have the dividends. On bonds, you have the income, and on real estate, you have the rents. Even if the price doesn't go up, you still have some revenues from your investments. Personally, I'm invest mainly in equities and real estate. That's my two main my preference. First, equities, because it's the asset class where the return is the highest. It's 6% net of inflation in the last 120 years. Real estate is second, 5.2, I believe, 5.2%. And bonds, it's more to have a portfolio a bit more balanced. Return is only 1.4% net of inflation again. So return is definitely lower, but it reduces the risk of your portfolio overall. If you only have equities, probably a bit too risky.
Yeah, you apply all this sort of approach to your coaching, because I understand you coach.
Yeah,
and
yeah,
you
exactly.
have clients that you manage in a way their portfolio. Do they actively get involved in the markets themselves, or are they more passive? Although you're coaching them, are you kind of almost guiding every step, or are you very proactive in that?
When I help them, the idea is to to teach them a way to invest that they can replicate themselves on their own. That doesn't take any time, because most of my clients, they're not in finance. They don't care about financial markets. They want to invest over the long term, but many don't have a clue about financial markets. They know nothing, and they have no intention to learn deeply and to follow the markets every day. So the method I've built is really for someone who wants to spend the least time possible. And for that, so it's mainly based on ETF. It's passive. The idea is to invest the same in the same ETFs every month. Regularity is a key factor for performance over the long term. First, you design your own portfolio. The rule I start with is the age rule. So, for instance, if you're 40, your portfolio should include 40% of safe assets. The idea is, when you're young, you can start with a relatively aggressive portfolio. You can take risk. You don't have much assets, so even if you lose 30%, you will easily catch up with your salary, with your savings. The more you approach the retirement, the more you want to invest on safe stuff. You don't want, when you have if you have a few £100,000 invested in the stock markets and you're 65, you don't want to lose 30% just before you retire.
Exactly.
So that's why I think this rule, this age rule, is an interesting starting point. So 40, you have 40% in safe assets, bonds, for instance, potentially a bit of gold and commodities in some cases, and the rest, so the other 60%, in risky assets, mainly equities and real estate.
Were you doing any of these kinds of investments with leverage 20 years ago when you were younger and more perhaps aggressive with your sort of approach?
With leverage only for the real estate. Not well, in France at the time it's not possible to borrow some money to invest in stock markets, and I wouldn't necessarily recommend to do that because it's quite risky, and money shouldn't be an issue. But you don't want to create, by managing your portfolio, you don't want to create additional stress in your life. If you are a professional, fine, you can cope with that stress, and but for an individual, I think the goal should be to be as relaxed as possible, to do other things in life where you want to spend more time on.
Yeah, and I have found as a retail trader using leverage, possibly a stupid thing to do. You know, it can be very stressful. Even if you're doing quite well in the day, the level of concentration you have to give to a chart, you know, constantly looking, it is quite draining. I mean, it's just sort of the intensity of playing chess or something like that. You know, it's constantly pulling on your mind. Is it going this way? That I've got to look at the dollar, what that's doing today. I've got to look at the news, you know, non-farm payroll or whatever it might be else coming out, you know. So you've got to look at those things, and especially if you have a day job like I do anyway, you know, your mind is a bit...
Exactly, and I've done that when I started trading on my own, so 20 or 25 years ago. I used leverage at the time. I remember some days really stressed. I had put maybe 50% of my portfolio in one stock, and that stock went down 30% that day. So yeah, no, it's not a good feeling. So I would recommend to diversify first, avoid leverage other than for real estate. That's the two main rules to keep your sleep at night.
Statistics are really a bit grim, aren't they? You know, brokers say typically 76% lose money when they trade, right? The reality is closer to 90.
Yeah, that's the figure I had in mind.
Yeah, 90, and then 5% break even and there's like 5% that make money, not necessarily a lot of money. They just they're in profit, right?
It's interesting you're saying that, because it's exactly the stats I was given when I opened a future account. So I was already working in finance. I was talking to traders every day, and the guy who opened my account started to ask me lots of questions about financial markets, and I was a bit surprised. I had told him, "Yeah, but I'm in financial markets. I know how it works." So I asked him, "Oh, but why are you asking me all these questions?" And he said, "But you know that 90% of my clients lose money, 5% break even, 5% exactly the same stats."
Yeah.
And basically, what the 5% on futures, at least because it's what people win, other people lose. So basically, what the 5% of the people win is what the 90% of the people lose. That's why those who win make a ton of money, but they are only a minority. So yes, that was an interesting stat. I mentioned it in my book actually. I remember that day very clearly. And now, when I look at the performance for traders, more professional traders, I see similar stats, and that's a bit more surprising. But we often see 90% of portfolio managers behind their benchmarks, and that's why the passive industry, the ETFs, why they have so much increased in the last 20 years. People started to realize that they have an easy way to make a reasonable profit.
Yeah, because you're spreading your risk really. You're just diversifying, aren't you?
Yeah.
You go into one sector like gold mining or whatever it might be. You know, do you have certain sectors you favour in the last 12 months or so?
No, personally, I don't look at specific sectors. I'm going as broad as possible. So I usually invest in MSCI World ETFs, something as broad as possible to diversify as much as possible.
Mm. So would that possibly be more American than European, or
no,
a bit of a mix, really quite a mix?
It's the world. So I diversify in terms of sector, in terms of countries. Well, the MSCI World, it's I think it's 55% US. So more, well, it depends, but roughly a bit more than half is US. Maybe 20-25% Europe, and the rest Asia.
Have you found the more recent bear market we've been in? I think we're sort of, it's a debate, isn't it? Are we out of it, or are we still in it? One leg in it, one leg out. I don't know. But have you found it more difficult in this last year or two than, say, I don't know, the decade before?
Not specifically, because my goal is to invest the same thing every month. And for that, when the market goes down, it's actually an opportunity to buy a bit cheaper. But that's for my personal investing. The volatility in the market impacts more my daily jobs than my personal investing, because what I do personally, it's really same thing every month. So if the market goes down, as long as it doesn't go down for too long, it's good.
Yeah, what have you made of all these scare stories coming out really for the last year? There have been more and more, the market's going to crash because the inflation, because oil, because nat gas, all the stresses and the wars, and then of course the big one, the debt, the debt everywhere. What's your take on that? I mean, there's all this fear. I mean,
there is always a reason to fear something. So at the moment it's inflation. But 10 years ago, it was more the debts. In 2008, it was the end of the world with the financial crisis. 2 years ago, it was, or last year, it was Ukraine. There will always be a problem somewhere. And that's a bit the media's fault. They always insist on what's wrong, not what's positive. So people will always be scared by something. The inflation is at the moment as investors is a concrete problem, probably more than Ukraine, inflation, yeah, it directly impacts on daily lives, and you can see your assets, or at least your purchasing power going down. Yeah, overall, I tend not to be too focused on the news, to not be too demoralized.
Yeah, the analysis that your team are using, if you like, it's algos, and what other kind of data are you feeding into the algos to get the plan that you want to use?
We have many sources where we get all the balance sheet from the companies. So we get their results, all the news, etc. We have a ton of data. So we spend quite a lot, like companies spend quite a lot of data, quite a lot of money on data to get as much information as possible on 20,000 stocks in the world. And the model will analyze all this data, will compare stocks from one country, from one sector, from various different angles. And for each stock, we'll define what they think is the theoretical price. Then we compare the theoretical price to the current price. And when we see a big spread, that's an opportunity to buy or sell. So all this is done by the model. Then the portfolio manager analyze the output of the model, look at the news, what could go, because sometimes prices, the model suggests one thing, but there is a big news coming out, or there was something reported last week that's not included yet in the model. So there is still a strong element of monitoring of the model's output, and then the portfolio manager give us the recommendation. But everything is based on fundamental analysis.
What are the metrics that I mean, obviously there are more than a few, but can you give me some key metrics that you look at on a regular basis? As a trader or as a portfolio manager? Both really. Yeah, both really.
Portfolio manager, so in the model, they would look at the depth ratio, on the profits, revenues, the growth, so all the fundamental criteria to analyze the value of the stock. They also look at prices factors. So the momentum, for instance, has the stock gone up significantly in the last year? Stocks like that, stocks who go up in the last year, for instance, they tend to continue going up. So it's one of the elements that the model takes into account. Also some ESG criteria as well. We have thousands: environment, social, and governance. So it's all the green stuff. All these criteria are included in the model, and then it gives us some recommendation. On my end, on the trading side, it's going to be more. We look at the liquidity of the stocks to know how much we can do in how long, and I might use also some technical analysis, technical indicators, candlesticks or average, resistance, support, stuff like that, and mainly the news as well. So we have to adapt to the news that will be released. So if the Bank of England makes a decision that day, it probably impacts the volume curve as well. So we have to take that into account into our trading plan.
Sure. Do you look at volume profiles?
Yeah, definitely. Now, most of our trading is done through algos as well. So for instance, when the portfolio manager tells us, okay, trade over the day, the algo we use will automatically look at the volume profile of that stock. For instance, they would look at over the last 20 days. Usually we do 10% of the volume of the day in the first hour, 50% before lunchtime, 20% at the close between 430 and 435. So the algo define a volume curve, and we tend to follow that curve. But sometimes if there is a news, for instance, the algo might predict we have to trade 50% of the size in the morning. If there is a big news, the profile, the volume profile might change drastically, and we have to adapt to that.
Yeah, I don't know about you, but just looking at the markets in the last few months, the character of the momentum seems to have changed in as much that we seem to have longer periods with almost nothing happening, and then huge eruptions of price movement. Is that?
It's the same. It's funny because I had a discussion with another trader last week, and we have some days where it's super quiet, and some days where it's extraordinarily busy.
Yeah.
For Friday yesterday was surprisingly busy for me. Day before, nothing.
Yeah, I mean the euro and then the dollar. I mean that affects shares straight away.
Yeah, it depends on what happens in the market. If the markets are quiet, usually the portfolio manager don't make new recommendations, or less than fewer than usual. But on days where the volatility increase, it will trigger some changes in the portfolios and then new trades for us. So we have to adapt to the volatility in the markets. Part of our job.
Sure. And going back to the job, what are your hours? Are they kind of very civilized, or are you sometimes up at 11 o'clock looking at charts? Or
we usually start between 7 and 7:30, depending on 7 if it's busy, 7:30 if it's quiet. We stay. The equity markets shut down at 4:35, so we have to stay a bit after to monitor that the trades have settled correctly, etc. FX continue a bit. We trade FX until 5:30, and then so on average I probably leave 6:30, something like that. So let's say from 7 to 6, that's a typical day. Sometimes we have to stay later, but if there is a big event coming up, or if we have an operational problem, or trades we haven't received the field, the execution, the trades from the brokers, but it's quite rare. On average, I would say it's from 7 to 6.
Cool. And what are your plans? I think this is the final question, really, for your coaching coming up.
I just released my book.
That's right, you did.
Yes. 2 weeks ago. So I've been working on it for 4 years. So I'm quite excited to have it released. I was invited to a talk show on TV in France last week. So I'm trying to promote the book at the moment, and hopefully develop the coaching next year. I only have a few clients, so I help them reach their financial freedom as quickly as possible, based on 4 pillars. It's the same 4 pillars than on the book. The idea is to save more, so increase your saving, ideally at least 20% of your salary. Then to try to maximize your salary, develop new skills to try to negotiate a better salary with your employer. The third pillar is investing in real estate. Buy your own house as early as possible to avoid wasting the rents every month. And fourth, invest in stock markets to generate a second source of income that will progressively replace your salary. And if you follow these four steps, you can reach your financial freedom. That's my goal. I want everyone to be financially free, so they can focus on their passion, anything else, rather than being focused on money.
Yeah, le million pour tous. Do you have a translation?
It would be The Million for All.
Yeah, I meant, do you have a translation of your book? Because that's a French title.
The book is in French for now, but I would like definitely to translate it in the year or two. I guess it will depend on the success of the book in France. But definitely, I know people in the UK or in the US or in Anglo-Saxon countries, they are usually more interested in personal finance, in self-help. So there is a big market for that kind of books here. So I'm hoping to translate it at some point.
Do you think this might become your big passion, coaching, rather than being at the office trading, you know, on institutional size? Is that kind of where you're going?
Potentially. It's funny because my boss asked me the same question a few weeks ago. At the moment, it's a side business, and I quite like doing both. I love my job as a trader, and I love coaching people as well. It will really depend on opportunities, but at least it's good to have this backup in case I've made redundant or something. If I lose my job at some point, it's nice to have this activity. And if it becomes really successful, why not doing this full time? Yeah, it will depend on opportunities. I'm open to everything at the moment.
Cool, great. Well, Raphael, thanks so much for being on the show.
Thank you very much.